Hey everyone, and welcome to learning how to trade the Ttm Squeeze. So first and foremost, I'll show you how to actually get it on your Thinkorswim platform. So we go up here to the Edit Studies tab, we click that, we come into Studies, we type in TTM, and it should be right here. It's called Ttm Squeeze. Double click that. It'll populate this lower column, and we hit Apply. So now this is the Ttm Squeeze Indicator. As you can see, it is a histogram bars with green dots in the middle and then also red dots. So explaining what the actual squeeze is here, when we have light blue bars, that means that we have bullish momentum in the stock above. When we have dark blue bars, this means that we are gaining bearish momentum in the stock. Dark red bars here, this means that the stock does have bearish momentum within it, and then these yellow bars are indicating that it is gaining bullish momentum. So these green dots mean that there are no squeezes within the stock until we get to these red dots right here. When you get your first red dot, this means that a stock is in a squeeze, and this is where I'm always looking to get into a trade. So what these actual red dots mean, let me pull up this right here. Okay, so what these red dots actually mean. This yellow line here is the Bollinger Bands, and these dashed lines that are blue are the Keltner channels. So a squeeze develops when the Bollinger Bands come inside of these Keltner channels. This just means that the stock price is getting very narrow and it's kind of an exhaustion period or consolidation period waiting to make its next move either higher or lower. So you can see here, we can look at this red, look at these, we have the Bollinger Bands inside the Keltner. We come over to this one right here, you have the Bollinger inside the Keltner, and it's the same thing every time. This is exactly what this indicator on the bottom is showing you. I'm just showing it up here actually on the screen what it is actually meaning. So if we go back to here, now that you actually know what the squeeze is and what it's actually doing, you can see now that in these moments of time when there is consolidation, this is where you want to enter into trades before it makes an explosion higher. And in this case, it made an explosion higher. In this case, you can look here, made another explosion higher. The squeezes do not always fire to the upside. They can go both ways, but in this stock Apple, it did go to the upside. So when we're looking at stocks, you want to see these red dots. You want to either be looking to the upside or the downside based off the color of the histogram that it is giving you. And anytime you want to look long, you want to see these light blue bars or these yellow bars. Anytime you're looking to go short, you want to see these dark blue bars or ideally those dark red bars. So now looking at some other examples of squeezes other than just Apple, we can go over here to Google. You can see you had a nice daily squeeze. This price was consolidating, consolidating, consolidating. You got into a squeeze, and then it made its next leg higher. Same situation here. After that leg higher, it gets an exhaustion point where it needs to consolidate for some time. That's when the squeeze develops, and after that squeeze fires, which is when the Bollinger Bands come back outside of those Keltner channels, you can see you get an explosion in price to the upside. Now, it doesn't just work to the upside, as I said before. This can also work to the downside. So looking at plug here, you can see that we had these dark blue bars. We had a squeeze setting up. We had a period of consolidation here at this top. And then we got these red bars, which is meaning bearish momentum. And this stock fired to the downside. So this works both ways. It doesn't have to just work one, which is why it's such a nice indicator to have, because you can play both sides of the market. So now just looking at other examples, this works for all stocks on all time frames. I personally prefer to use it on the daily time frame for swinging, because this is what works best for me and what I found. But here's just another example. You have your red dots, which is your squeeze, a period of consolidation within a stock, and then once that squeeze fires, you get this larger than expected move to one side or the other. In this case, it was to the upside. Here we can look again. Amazon here has had one in both directions. So if we look here, we had this squeeze setting up. We have the dark blue bars into red bars, and this is where you get your squeeze firing to the downside. Here we have our light blue bars, which is bullish, and this is where you get your squeeze pushing to the upside. Same with this one right here. You get your light blue bars from the yellow bars, and this is bullish. This is where you get your push to the upside. So now you can look at this and see, okay, this would be great to enter in here, but how would you know to actually enter at that level? One of the things that I like to do, and we can add it together, is a moving average. So you come to moving average exponential, double click that, come in here to this little gear icon, and change this to 21. So the 21 EMA. Hit OK, hit apply, and now we can zoom back. So in each of these situations, I like to ideally get entries at that 21 EMA to either the upside or the downside. So this level, 21 EMA, stock will always push away from it and then revert back down to it, push away from it, revert back to it. It's always a place that it always comes back to no matter what. So if we look back here at this squeeze that fired to the downside, you can see that this one closed below that 21 EMA. Would have been a great place to get short on this one before it broke down to this downside, pushing away from that mean, and then once again reverts back to it. Here, if you were looking to the long side, you would want to get an entry right here, right at that 21 EMA before the squeeze is actually fired, so you can get in the move, and it pushes up, extending away from that 21 EMA, and then obviously reverts back to it. You're wanting to take your profits obviously once it makes that push, but this is your ideal place to make an entry. Let's look at another example. With Google, we can go back here and we can see the perfect entries for this one as well. If you're looking at this one, you can see the yellow is turning into these light blue, which is meaning you're wanting to go long on this. You can see that price was just hovering around this 21 EMA, so any of these spots would have been actually in an ideal place to get long on this one. And then you see it makes that long extended move to the upside, and that's where you want to take your profits before it reverts back down to this 21 EMA. Similar situation with this one right here. You get your yellow turning into blue. We have this consolidation right around that 21 EMA with price not moving a whole lot. You enter the stock long around this level before it pushes up to that extended range before it reverts eventually back down to that 21. Now looking to the downside, it's the exact same thing. Once again, we already discussed this squeeze, but if you get an entry around that 21 EMA, it pushes way down. You want to take your profits here before it reverts back to that 21, or even here before it reverts back to that 21. So always looking to make a push away from that mean, taking your profits, and then letting the stock revert back to this mean. So this is how I trade the squeeze, and hopefully it helps you all understand a little more of a trading strategy that you can use in your own trading style, and hopefully it will help you take more profits out of the market.